Good day, everyone. My name is Yvonne Wong, matrix number 305273. Today, I will present about my assignment, which is a study on Bank of New York Mellon, which called BNY Mellon in United States of America, the determinants of credit risk. To provide some essential background, the BNY Mellon is classified as a global systemically important bank. Unlike typical retail banks that serve everyday consumers, BNY Mellon operates primarily as a custodian bank. This means its foundational business revolves around safeguarding and also servicing massive investment assets for large institutions, corporations, and governments. However, despite not being a conventional lender, BNY Mellon remains deeply exposed to substantial credit risk stemming from specialized corporate lending and complex interbank transactions. In this study, credit risk evaluated through the lens of the non-performing loan ratio, which measures the percentage of loans that are in default or close to default. By examining a 10-year period from 2015 to 2024, this research aims to analyze how both internal and external factors change in the bank's risk profile. So, moving to our problem statement, it highlights that effective credit risk management poses a high-risk threat that can inflict catastrophic financial loss, directly threaten a financial institution's survival. History has shown us that individual bank failure can paralyze the entire financial industry, as proven by the widespread bank collapse during the 2008 global economic crisis. Even a global critical custodian bank like BNY Mellon remains exposed to significant transaction and corporate lending risks. To address this issue, our research objectives and also research questions are separate to three. First, for the first risk objective is to determine the impact of credit risk on bank-specific factors of BNY Mellon. Second, to determine the impact of credit risk on macroeconomic factors of BNY Mellon. Third, to determine the impact of credit risk on bank-specific factors and macroeconomic factors of BNY Mellon. Consequently, for our research questions, first, is there any relationship between credit risk and bank-specific factors of BNY Mellon? Second, is there any relationship between credit risk and macroeconomic factors of BNY Mellon? Third, is there any relationship between credit risk and bank-specific factors with macroeconomic factors of BNY Mellon? Our literature review established a comprehensive theoretical framework by dividing the determinants of credit risk into internal and external factors. Credit risk is benchmarked by the non-performing loan ratio, where poor management of this ratio serves as the primary trigger for systemic failure. When looking at internal factors, such as profitability and bank size are crucial. A higher return on assets indicates superior risk mitigation capabilities, while the natural law of total assets reflects whether advanced risk tools are being utilized or if a too big to fail appetite is present. Furthermore, aggressive lending practice met by the loan to deposit ratio alongside asset quality indicates by higher loan loss provisions and net charge-off heavily escalate risk. Operational inefficiencies and structural fragility via high leverage ratios further weak the balance sheet. Externally, macroeconomic factors paint a broader picture. Economic health tracked by GDP growth typically boosts debtor income and lowers default rates, whereas high inflation and volatile exchange rates strain repayment capacities. Additionally, shifts in market liquidation via the bought money supply and recessionary signals from a negative output gap and are critical indicators of widespread debtor default trends. The methodology of this study is to focus on the BNY Mellon in the USA over a 10-year period from 2015 to 2024 using annual financial reports and national macroeconomic dataset. To analyze this data, we have separated to three models. Model 1 is isolate internal bank-specific factors. Model 2 is focus on macroeconomic factors. And finally, for model 3 is combine all internal and external factors into a single model. Reviewing on descriptive statistics, the bank's average credit risk and NPL ratio sit at around 21.30%. This means about 21% of their loan portfolio face issues over the 10 years. For the loan loss provisions, it has high internal volatility. It's because it has a low mean in 0.0719 but high standard deviation in 0.2428. This shows the bank aggressively changed its rainy day funds depending on the economy. For the stable assets, ratios like bank size and return on assets have very low standard deviations. This proves the bank's baseline structure stay highly stable. For the macroeconomic factors, money supply has the highest mean at 70.03390 and high standard deviation in 3.8271, showing big shifts in USA market liquidity. GDP growth maintained a steady average of 2.29%. For correlation, the most significant factor is non-performing loans. It has a perfect positive relationship with a significance value of 0.000. This means actual loan defaults are the strongest driver of credit risk. And for the highly significant factors, which is net charge-off, it has a highly significant at 0.004. This proves that real financial write-offs are tied direct to risk jumps. For the insignificant internal factors, which is loan to deposit ratio, it has a insignificant with a p-value of 0.481. This shows the bank's baseline loan volume relative to deposits does not change credit risk on its own. And for the insignificant factors for macroeconomic is GDP growth with a p-value of 0.352 and inflation with a p-value of 0.447. They are completely insignificant. This proves that general economic trends alone do not automatically change BNY's Mellon's credit risk. For ANOVA, the model 1 shows that highly significant with a p-value of 0.000. This is because the internal factors are valid predictors of credit risk. For model 2, it shows that not significant with a p-value of 0.992 is because macroeconomic factors alone do not mathematically calculate the bank's credit risk shifts. Lastly, for model 3, it shows that highly significant with a p-value of 0.000. The mix of internal and external factors forms a reliable predictive tool. For model summary, model 1 has shows that it achieves an adjusted R square of 1.000. This means bank-specific factors indicator account for 100% of the change in the bank's credit risk profile, while for model 2, it achieved an adjusted R square of negative 0.748 and has a very low R square of 0.029. This means external factors alone explain only 2.9% of BNY Mellon's credit risk variance. And for model 3, it also achieved an adjusted R square of 1.000. Integrating the external economic metrics alongside internal portfolio ratio maintains a flawless 100% explanatory power. Lastly, for coefficient, the model 1 shows the only significant predictor, which is non-performing loans. It has achieved a p-value of 0.000. When looking only at bank-specific factors, actual loan defaults dominate all other indicators. For model 2, no external variables are significant on their own. Factors like GDP has achieved p-value of 0.769 and money supply, it has p-value of 0.854, fail to isolate credit risk adjustments independently. And for model 3, the most significant for internal factors has non-performing loan, risk-weighted assets, management efficiency, net charge-off, return on asset, and also liquidity ratio. Their p-value is less than 0.05. And for the most significant for external factors is the output gap, which has achieved the p-value of 0.042. It's the only significant external factors when combined with internal factors. Lastly, for our conclusions, the internal factors like non-performing loans and also net charge-off are the definitive indicators for predicting credit danger, while for the macroeconomic environments, cause borrower distress, but BNY Mellon's specialized custodian bank structure and internal factors serve as the true defensive barriers against market failures. Well, for our recommendation, first, BNY Mellon must enforce strict non-performing loan tracking, prioritize highly rigorous monitoring of asset quality trends to intercept credit default accumulation before it spirals. Second, the bank needs to dynamically adapt its cash buffers, fluidly adjusting the liquidity ratio upward to build protective barriers during identified cycles of market stress. Third, management should actively utilize output gap forecasting as a feature, macroeconomic early warning system to anticipate systemic overheating or recessionary markers. Finally, the bank must continually drive internal operational efficiency to maintain optimal management parameters, which will safely support stable asset profitability across long credit cycles. That's all for my presentation. Thank you.